The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today for the last time as co-host of the Chanticleer podcast is the senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you?
Well, I got mixed feelings, James. I'm sad to be going, but happy to be here again.
Fantastic. And of course, we're joined again by our newest recruit to the Chook Pen, Street Talk guru and soon-to-be Chanticleer columnist, Anthony McDonald. Anthony, how are you?
Yeah, good. Looking forward to the podcast.
Fantastic. Well, this week we're going to look at the brave new world of Australian banking, examine the dramatic battle for the hottest lithium company on the ASX, and we'll pay tribute to our much-loved colleague, Tony Boyd. Now, Tony, of course, this is a special event and a special farewell, but geez, you've gone out in style this week. You've kicked off the Festival of Tony, as I've called it, with some fantastic yarns. Breaking yarns, kicking ass and taking names, I've called it. I want to start with the yarn you broke on Monday morning, which revealed that Bank of Queensland Chairman Patrick Allaway would become CEO of the group, replacing a man that you wrote a lot about, George Frazis. Tony, give us a little bit of the backstory here. What happened to George, and were you surprised that Patrick's moved from chairman to CEO?
Well, George was dumped really suddenly in November last year after the board basically lost confidence that he could execute their requirement for resilience and financial stability, and they really also wanted to pull back from growth because they were going hell for leather in home loans under George. Now, I had earlier in the year written a piece about George and his unique management style, and some of this included what you might call sort of excessive corporate expenses, those type of offsites that we never see anything of at the Financial Review. But anyway, I got the sense that Patrick, when he stepped into the job, wouldn't just be a temporary person because as the economy, started to respond to higher interest rates and then we had global financial turmoil, it really didn't make sense to get a new CEO in who might change all the executive ranks and upend the whole place. But I did find it strange that Patrick said he'd only be there till December 2024. I know you wrote a good column saying this was like a Band-Aid CEO, but what do you think? I think he's going to be there a lot longer, don't you?
Oh, I think there must be a chance. I mean, it's very weird that a company's sort of forecasting that it's going to have 3 CEOs in 3 years. That's not great succession planning or a great morale boost for the people inside the company. So I think you're right. There is a chance he'll stay longer. He says there's a chance he could go sooner if they found the right candidate, but they couldn't find the right candidate externally, and they say they need to do some more training of people internally. So I'm with you. I think this is going to take a little bit longer to play out.
And the other sort of unusual thing I noticed Patrick talking about, he'd rather be in Sydney than the sort of Swiss crisis that's occurring. But this is a Brisbane-based bank.
Bit of a faux pas.
Look, I think a whole lot of the managers are in Sydney and not in Brisbane. And I sometimes wonder about, getting too far from your roots.
Yes.
Might be not a good strategy.
Yes. Well, Tony, on Wednesday, you had another cracking story, an important update to a yarn that you've been following really closely for a long time, and that's the botched replacement of the ASX clearing and settlement system, which is called CHESS. Tony, can you remind listeners what the CHESS system does and bring us up to date with what happened this week?
Well, CHESS is basically the plumbing of the $1 trillion cash equities market. It functions so that when you sell a share, in 2 days it'll be settled. And the ASX covers that sort of interim period with, I think they have $540 million in collateral just sitting there in case there's a problem. But of course, this project started 7 or 8 years ago and then collapsed in a heap with a $250 million write-down. And that really was, I thought, going to be a problem right from the start.
Yeah.
When you own part of the technology provider, you've got too much skin in the game and you can't necessarily make independent decisions. So, look, they wanted to be right at the cutting edge using blockchain and all that sort of thing. But really, we've ended up in a situation where the old chess is actually become the good chess because it might really be around till 2028, 2029.
Yeah.
But what happened this week was absolutely unbelievable, I think, for the damage to the credibility of the board and particularly the chairman, Damien Roach, is that the ASIC, the Australian Securities Investment Commission, said they're investigating. Sorry, the ASX admitted that they were being investigated by them for a whole range of things like false and misleading conduct. But the big one that stood out was suspected breaches of continuous disclosure, which pretty bad for the market operator that happens to also be a regulator.
Not a good look. Anthony, the three chooks have been lucky to be in Sydney this week together, and we went and had lunch with one of the country's top investment bankers. Fair to say that there's a fair bit of anger in the banking and financial services sector here about how badly this CHESS replacement's been handled.
Yeah, there sure is, James. Like, all the brokers have spent a lot of time and money preparing for this CHESS replacement system in the past few years. And now that's all been dusted. Like, they're asking, and they have been for a while now, like Tony just said, what's wrong with the current system? Why does the ASX have to be so far out in front of all the other exchanges around the world and lead the way down this new path? They say there's been quite a few big days in terms of trading recently, some $16 billion days, and CHESS coped just fine. So if that's the case, why did they have to spend all this time and money preparing for something that maybe wasn't needed?
And the powers that ASIC has to get information about what was really going on inside the company, I don't want to send shivers down the spines of the directors of ASX, but potentially my retirement. This could be a book, James. What do you reckon?
Really? Oh, well, we promised to put an extract out on the Chanticleer podcast and have you back as a guest, Tony, when it comes to time to promote it. Well, keep your eye on all good bookstores, listeners. All right, let's move to our first big topic of the week. And on Tuesday in Sydney, the biggest leaders in Australian banking, including Commonwealth Bank's Matt Comyn, Westpac's Peter King, and John Lonsdale, the head of the prudential regulator, in his first public speech, actually, sent a clear and resounding message to the Australian public. The Australian banking system is very strong and very different from those in Europe. Tony, this was a rallying cry, I guess you might say. We're not the same as Credit Suisse and Silicon Valley Bank, so I don't think that we are.
That's right. And look, the two things that stood out to me were the fact that the Financial Review can pull the leading people in financial services into Australia into one room with an audience of about 400 people in the room and another 250 online. So it was, in that sense, a great success. But I wrote a column saying we've got Fortress Australia when it comes to banking, and it's a tribute to the financial regulator, although I think one of our colleagues, Jonathan Shapiro, wrote quite a good column about, let's not get carried away. But I think I like that apparent harmony between the big bankers at Westpac and CBA and APRA, APRA's chairman, John Lonsdale, that's the Australian Prudential Regulation Authority. They're the ones protecting your deposits. And it's good to know that they're on the same page as the big banks.
Yeah, that's right. Anthony, Peter King and Lonsdale and Comyn have all been studying what's happened at Silicon Valley Bank and Credit Suisse. As you would imagine, they're all glued to it as much as we are, probably more. One of the things that King called out was the sort of speed with which things are unravelled, and maybe that's a bit to do with social media and a bit to do with the digitisation of the banks. Is this something that you think regulators and bankers can do much to sort of reverse? Can they put a bit of friction back in the system, having worked so hard to design it out?
Yeah, like the banks have been collapsing for years, and I think so that bit of it doesn't surprise anyone. But the pace of these ones is what's been most memorable. And it's all about how quickly information spreads around the market. So, now that when there's a run on a bank, it can just spread like wildfire. And, a day or two can make all the difference in the life of the bank. So, APRA, as it said, has been stress testing the banks and looking at all the usual factors like the unemployment rate, house prices. It even added cybersecurity. But you just kind of wonder how it's going to test with things like social media and the spread of information. Because as we saw with Credit Suisse, like the CEO can get up and say, no, we're fine. The regulator can say it's fine. But if customers think it's not, then they're pretty quickly to ask for their money back.
Yeah, absolutely. Absolutely. The other thing, Tony, I found was really interesting. While we're having all this turmoil in global banking, the Australian banks are going at each other absolute hell for leather. Mortgages are being written well below the cost of capital. They're sub-economic, as UBS described this week. And business loans, Bendigo said their head of business banking got up and said, well, hang on, the same thing's happening in business lending. There's a lot of loans being written below the cost of capital. Do you find it strange, Tony, that this is... It's a bit of a parallel universe moment for me. Like, we've got banking crisis, and at home, the banks are going at each other like crazy.
Yes, well, maybe we do live in it's Fortress Australia, but it's a bit of a bubble from the rest of the world. I suppose they've got all that capital. They now have 2.5 times more capital than they did before the global financial crisis. They've got to deploy that capital, and the way they deploy it is to leverage up their capital by 10 times. And interesting that I asked Peter King, what did he think about all this mortgage competition? He says, there's never been a better time to write a mortgage. And you go, why? And he says, well, because there's a 3% buffer there being imposed by the regulator, APRA, on top of what are the highest sort of variable interest rates in more than a decade. You put all that together, the only people borrowing at the moment must have incredible cash flow and income.
Yeah. It's a really interesting point. Anthony, what do you make on that point? It is uber competitive out there. My sense is that the banks are starting to think about the strategic choices that level of competition makes. Once upon a time, you get a 30% return from a mortgage. Now it's 4 or 5%, well below the cost of capital. This cash cow is suddenly not what it used to be.
Yeah, the world's very much changed for the banks, and that really came out through the conference and other chats that we've had with bank CEOs this week. It's been a huge week for sort of learning about the banks and what the CEOs are thinking. I mean, UBS did this really good note midweek, and they found that banks at the moment are probably making 4 to 5% return on mortgages that they're writing. So every year over the course of the mortgage, they'd make 4 or 5%. But the bank's cost of capital is sort of at about 5%. So they're not really that economic. So there's sort of big questions being asked about the future of the retail banks and where they sort of take it. If conditions last like this, then it's hard to sort of see where they should be chasing.
Yeah, it's hard to see their profits growing as they've done. So let me pose the same question to both of you. What are the risks we need to think about over the next 10 years for the banks? They're a huge part of every investor's portfolio in Australia, whether directly or through their super fund. What are you thinking about, Tony, as you look out 10 years?
Well, I look at what Peter King said, that the big will just get bigger. And we might end up with, we have the big 4 banks and 2 or 3 regionals. We might just have, at the end of the day, 4 big banks and no regionals. I think Macquarie will still be there, but I do wonder about Bendigo and Bank of Queensland. I mean, already Suncorp Bank is up for sale. Yep. AMP's got a little bank. Basically, Peter said that the costs of maintaining cyber defences, investing in new technology. I mean, we know CommBank's putting out a new app. They're testing it with all their staff at the moment. They're the leaders in technology. Everyone's going to have to keep up with them. It doesn't look bright for that sense of, a competitive market with lots of smaller banks trying to, compete with the big ones.
Yeah. Anthony, what's your crystal ball say?
Feels like there's a bit of tension inside of banks about capital that they've got, spare capital, and where it goes versus shares, whether it goes back to shareholders or whether they can reinvest it in the market. So all the banks have gone through these big asset sale programs, and as part of that, they've raised lots of money. So often they've sort of kept $1 for themselves to reinvest in their own business and given $1 back to shareholders. Now, those asset sales are kind of drying up. Yeah. Most of the banks have cleaned up what they've had to. So they're kind of running out of that extra money to give back to shareholders. So for me, the obvious place to look is dividends. I mean, that's what the Australian banks are sort of there for, and as far as investors are concerned, and whether they'll be able to sustain these high yields.
Yeah, that'll be a big worry because as Anna Bligh, the head of the Bankers Association, reminded the audience at our banking summit, the big four banks are the four biggest taxpayers in Australia. So they've got all those tax credits sitting there for distribution through their dividends. And if they have to cut their dividends, then they've sort of got a bit of a wasted asset, haven't they?
Yeah. It was quite amazing, the banking conference, just the way that the mood had changed in the past 3 weeks since our big summit. 3 weeks ago, everyone was talking about profits and maybe banks were getting a bit worried about governments coming after profits.
Yes.
Whereas this week, there was no mention of that. It was all just capital safety because of Credit Suisse and SVB.
Yeah. My thing to watch in the next 10 years is the mortgage market. I think if the banks had their druthers at the moment, they would like to do an out-of-cycle rate hike, so raise the cost of mortgages beyond what the RBA is doing and restore their return on equity. There's no way they can do that because of the political pressure and the competitive pressure. But I think eventually the cost of a mortgage will have to rise because the banks will be trying to restore their profitability. So not great news for homeowners, but something to look out for. Well, while we were focused on the banking summit on Tuesday, Anthony and the team at Street Talk were all over what just might be the most fun takeover fight of this year. A big lithium producer called Albemarle lobbed a $5.2 billion bid for an ASX-listed wannabe lithium miner called Liontown Resources, sparking an incredible jump of more than 70% in the Liontown share price on Tuesday and really capturing the imagination of the market. Anthony, what's interesting here is that Liontown has been one of the most shorted stocks on the ASX. That is, it's had one of the highest proportions of investors betting that the stock was going to fall. Can you just help us with this a little bit? Why were the short sellers betting that the share price would go down? And what did that mean when the takeover bid landed?
Yeah, this is such a red hot story, James. I reckon this could be one of the corporate sort of colour stories of the year, depending on what happens next. But basically 3 years ago, Liontown shares were trading at 8 cents each. Right. And then fast forward 3 years, it gets a bid at $2.50. So that's a 30 bagger.
So it's gone from penny dreadful to actually respectable.
Yeah, I'm not
$5
sure.
$5 billion company.
I'm not sure it was even a penny dreadful. It was just the prospect of being a penny dreadful. It has gone that far. So whenever anything rises like that, there's always naturally going to be a fair bit of skepticism. The skepticism is particularly in the institutional investor market. This thing's come out of Perth. On the East Coast, the big brokers and the investors in Sydney and Melbourne can be wary sometimes of things that come out of Perth. There can be a bit of hot air around it. As the share price ran really hard, everyone, I think, realised that this could be a really good deposit. But they've seen the shares run, particularly just recently. And while they've also seen the lithium market soften up a bit, there's quite a bit of supply that's due to come into the market. So I think some hedge funds have seen this mismatch between Liontown's share prices and the share prices of other lithium stocks and what's happening in the actual lithium market. And they've shorted lithium shares to try and make the most of that difference, hoping that Liontown shares are going to go down. But what happened was that a bid came in from this big credible player, one of the two top players in the sector. And all of a sudden, those people that had shorted Liontown had to scramble to buy back stock to make sure that they didn't lose more than they were already facing.
Yeah, and that sort of compounds the share price rise we saw, right? It exaggerates it.
100%. So if you shorted this at $1.50 and the bid's at $2.50, you're staring at a 67% loss, right? And most of these guys might want to hang on a bit longer and sort of ride that through, but they've got stop losses and things. So all of a sudden, everyone's scrambling for shares at the same time, and that's why Liontown shares will finish at more than $2.50 this week.
Yeah. Tony, is Liontown in the Chook Super Fund?
It's not actually, no. I've got to get into those battery minerals, although I'm a little bit wary.
Yeah.
What about you? Do you look at it as a positive sector? Or?
Oh, look, I mean, this deal is a great test of hype versus reality, I reckon. Like Albemarle and Liontown are looking forward 20 or 30 years and saying the world's going to need lots more lithium because we're all going to move to electric vehicles and batteries and storage and all that sort of stuff. The lithium price has fallen from $75,000 a ton US last November to $40,000 over the course of like 5 months. So someone's wrong here, and I think that's another thing that makes this such an interesting thing. But Anthony, the best part about this whole deal is the fact that Liontown is not controlled by sort of big institutional investors like super funds. Most of it is in the hands of a bunch of blokes, and they're mainly blokes from Perth who all know each other. Tell us a little about this group called the Liontown Millionaires.
Yeah, it's the personalities that are making all the money here.
The personalities.
Someone read me out the share register of Liontown the other day, and the only big fund, as far as we see, was Pendle that had an overweight position.
Right.
And it wasn't even that overweight. The rest of it's in the hand of what you'd consider sort of insiders and friends of the chairman, Tim Goyder. So Goyder's got 15% of the company. That's an $850 million stake at the bid price. But in and around him, all these insiders have shares as well. So there's a drilling entrepreneur called Graham Clark. There's a couple of non-executive directors, Anthony Cipriano, Craig Williams. There's Liontown's former technical director, David Richard. There's the current CEO. Mate, all of these guys are sitting on $50 million or $100 million worth of shares. So half the company's in the hands of sort of 20 individuals, we think.
But what's important here, Anthony, I reckon, is that these guys also are all experienced mining people, and they're not sort of going to be pushed around by Albemarle. They know what they've got, and they want to drive a good deal.
Oh, 100%. But at the same time, they're diggers and dealers, right? That's the mining sector.
Yeah.
So, every mining resource has a price, and I don't know, it looks like these guys have either got lucky or knew something that everyone else didn't, but they're onto a good thing.
Yeah. All right. Last question for you, Anthony. Does the deal get done, and what price? So the bid's at $2.50. There's a lot of talk it needs to get to $3 or something. That's a pretty extraordinary jump. What do you think? Where do we get to?
Yeah, I'd say $3 is the asking price.
Yep.
Whether anyone will go there is another matter. But it's a really good resource, right? So lithium's a new sector. There's plenty of miners, big miners on the ASX that have been toying with the idea of lithium, right? So you look at someone like South32, not really in the critical minerals. Does it want to get into something like this? If it does, this is a sort of deposit. Look at, say, Fortescue. I mean, it would have to think, does it want to get involved? Wesfarmers is already in the sector. Does it want to double down? So, I mean, there's lots of contenders here, and the biggest one's Rio. But in lithium, it's all about matching projects with processing plants. So, I don't know. This story is not going away.
That's a very good point, about processing, because there's two good reasons why BHP, the world's biggest mining company, is not in lithium. And one of them is that they're fearful that one big project comes along and it just smashes the price down for years and years. So you might actually get these huge troughs where all your lithium shares are worth not much at all.
Yeah.
And then the second reason is that lithium ore is not the product that's getting used by the battery makers. They actually want the chemicals. They want lithium hydroxide and lithium carbonate. So it's actually the chemical processing industry that's making all the money. That's where all the margin is. That's where you get the $40,000 a tonne. So my reservation is basically, where in the value chain are the rents being made? Where are they going to accrue? And at the moment, for lithium, it's actually in the processing stage. It's not the upstream part of it.
Yeah, great point, Tony. It's just an incredible story. I can't wait to see where this goes next. The personalities versus the East Coast skeptics versus the US giants. So great fun. Well, it's time for a break, and when we come back, we're going to pay tribute to our very own Tony Boyd. Well, welcome back, Tony. This is a very sad moment. It's your last appearance as the host of the Chanticleer podcast and your last day as a Chanticleer columnist. Now, we will be trying to coax you back every now and again to give us an update on how the Chook Super Fund is going. But we've also got something really special for listeners next week. A special edition of the Chanticleer podcast with Tony Boyd and the legendary fund manager John Sevior, who also retired earlier this year. I've had a sneak peek of this conversation, and I can tell you it is not to be missed. There's some great insights, some great anecdotes, some great lessons, and even a few secrets that I didn't know about both Tony and John, so that's great. But Tony, as you know, we've been asking our listeners for a few weeks to send in voice memos, and we've got a fantastic collection. We really want to thank everyone who sent something in, and we'll play an extended edit of all of those comments after today's credits. But we wanted to play a few highlights for you right now, and we're going to start with the former Federal Treasurer and Nine Entertainment Chairman, Peter Costello.
You know, I think Tony is actually quite a positive guy. And when you're reading the newspaper, which is often full of doom and gloom, you can turn up Tony and he's crowing. And that's what he's supposed to do as Chanticleer, so I'm going to miss that. I miss in-depth coverage of companies too, in a sort of a sexy kind of way. It might surprise you, but he's as sexy as they get on the Financial Review.
I'm not sure you've ever been called sexy before, Tony, but
Well, it's funny Peter should say that, because my farewell card had on it that there is a Tony Boyd appreciation club among some of the female journalists at the office because of some of the clothes I wear. So I don't know where all this is coming from, but it's certainly not what I expected.
But there you go. Here's another one, another great person in markets, Jeff Wilson.
I'm talking today about Anthony Leonard Boyd, a fellow 1958 baby, and in terms of what he's achieved as the Chook over the last decade and a half has been exceptional. I can't thank you enough for your hard-hitting journalism. Thank you, Tony. And I know you're talking about retirement. Hey, I think you're just getting started. Well done.
Well, thanks, Jeff, and I actually concur with that sentiment. There's so much I want to do in life, and it'll start each day with a surf down at the break at Freshwater.
Fantastic. He's a great character, Jeff. Here's another one, veteran banker Lynn Cobley from the CBA.
Well, look, I'll miss the insights. He knows so much about Australian business, the breadth of it, the interconnectedness of it, what looks good, what is bad, where business intersects with politics. I mean, just that depth of experience, plus the ability to write in such a humorous way. I'll really miss that. I mean, Tony is the ultimate gentleman, and we've always enjoyed the insights, although hard-hitting at times, that he's been able to deliver to the Financial Review.
Well, I'd really like to thank Lynn for that. I mean, I've followed her career all the way from the Commonwealth Bank to Westpac and then, of course, back to the Commonwealth Bank on the board. I mean, she is one of the really high-achieving female bankers in Australia, and I really appreciate what she said.
And, Tony, I'm not going to tell you who this last one is. I'm going to make you guess, and you can tell us at the end who it is.
Hi, Dad. I started listening to the podcast as a sort of filial duty, I suppose. I felt somewhat bound to tune in as a good son, but I've grown into a regular listener, and I think that's testament to the podcast's quality and also to the great work of James and more recently Ant. I'm just dropping you a quick note to say that I'm, very proud of you, and you've been a great role model for someone who approaches work with professionalism and rigor, and breaks yarns, which is important, but also with a great enthusiasm and joy. And yeah, I just want to say, great job, and I'm looking forward to spending even more time than I already do with you now that you'll have plenty of time on your hands.
Thank you. Well, that's amazing. I'm starting to get a bit choked up.
Who was that, Tony?
Well, that was my youngest and tallest son who used to work on Street Talk, Tim. Thank you for those kind words.
Yeah, well, it's there's some great. Please stay listening after the credits. There's some fantastic tributes to you, Tony, and thanks to Alex Gow and Lap Fan, our producers, who have pulled them all together and edited them in such a fantastic way. Tony, a couple of last questions before you go. What have you loved about journalism? I mean, I think Anthony and I would agree it's such a good job, but what have you really loved about it?
Well, what I've loved is the thrill of the chase of a story that no one else has got. I mean, that really gets my adrenaline rushing. But I've also loved the incredible freedom, the Financial Review culture and working environment I've found to be fantastic because you're surrounded by people who are all self-motivated. There's no great master just ordering people to do things every day, like might happen in a widget factory. We're actually just keen to find out, information that will help our readers, whether they're trying to invest in their self-managed super fund or navigate their way through another complex policy that's been, issued by Canberra at very short notice. So they're the two things that really sort of stand out for me. And I suppose the third one is just great colleagues like yourself and Ant and Lap and Alex and everyone else who worked on the paper. And I must say the editor-in-chief, Michael Stutchbury, has been a great leader and still is. And I've appreciated the fact that he never told me what to write. And I think that's a reflection of how we are an independent source of quality journalism.
Yeah. What about, how would you say journalism's changed? I mean, obviously you probably didn't expect to be on the top rating investment podcast in the country, if not the world, that we've started 6 months ago. But how else has the job changed?
Well, because of technology and the way in which the internet, I suppose I was there in 2012 when the CEO, Greg Hywood, made about 1,500 people, mostly journalists, redundant. And it was quite cathartic for what was then Fairfax Media, later taken over by Nine. But out of all that came this new focus on serving a digital audience. And the subscribers to the Financial Review have never been higher. And that's a tribute to what we're doing. But yeah, the intensity of the work has definitely increased. I think when I started as Chanticleer in 2010, there was one Chanticleer lunch every year at a major hotel. And now the AFR events team has 18 summits, I think, or events coming up this year. The other thing is, of course, the podcast and broadcasting skills are something that I think young journalists have to learn now. So, you put it all together and trying to write a daily column as well of 1,250 words by 6:30, or filing that early one as you do by 11:30 in the morning to make sure our readers get it in the morning brief at midday is really important, serving the readers when they want to read the news. So I think they're the big changes I've seen.
Yeah, absolutely. Anthony, any last message for the King Chook here?
Oh, well, clearly from the messages, you've got a huge standing in the market and you've got better access to people than, the top sort of investors in the country. But what people probably don't see is you're also a big legend in the newsroom. You've the one person that people go to for advice, they go to for help with stories. You're always willing to give people time, even at 5 o'clock in the afternoon when you've got 1,200 words to write and these people aren't asking you about things that, these things won't be relevant for days. You always give people your time. You always look them in the eye. I remember when I started at the paper in 2010 and you were Fin Services editor. On my first day, you came up, shook my hand, looked me in the eye, wanted to know a bit about me. And I think that's your lasting legacy at the paper will just be that decency and time that you have for people. So thank you very much for being a great role model.
Yeah. Oh, look, thanks, Ant. And look, I have talked to Stutch, and I hope to come back as a contributor, not with the same intensity of the Chook, which is pretty tough. And I believe you're having a baptism of fire next week, Ant. You'll be on your own while James is away on holidays, and I'm sure you'll go really well. And I hope you have a wonderful career as a rooster.
Well, Tony, I'd second all of Anthony's comments and the comments of we've had comments from people, multiple CEOs, old Chanticleers have paid tribute to you, all very much deserved. I think this podcasting experience has been really great for us too, because the first few shows I think we got to the end and we thought, who'll listen to that? It's just me and Tony talking like we do every day on the phone, and it's been quite surreal that people have got something out of it. But that's what I'll miss. You're a great journalist, a great colleague, but you're also a great friend, and I've really enjoyed our daily chats where we get to sort of solve the problems of the world and share a bit of gossip and all that stuff. And hopefully on the podcast, we've been able to let people into that, a little bit of that world as well. So congratulations and go well. And hey, you have to do one more job too. You're taking us out with the credits.
Thanks, James. And I'm not even. Let's shake hands in the studio with my colleagues. You can't see it, great listeners, but it's very kind words, and I thank you. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, Tony Boyd, James Thomson and Anthony McDonald, and was produced and edited by Lap Fan and Alex Gow. Our theme is by Alex Gow. The executive producer is Fiona Buffini. I'm Tony Boyd. See you next time I'm a guest on the show.
Tony's always got such a great, fresh perspective on things and always a real point of view, and I always enjoy that as the first page I pick up in the morning and read.
That was Angus Dawson from McKinsey. And here's Peter King, Chief Executive of Westpac.
But on behalf of everyone, can I just say thank you. For those of us who have been written about, we may not have always loved it, but we always valued your insight, your professionalism, and the way that you tackled the big issues. So thank you very much.
Here's Fiona Carruthers from the AFR.
Tony Boyd, Fiona Carruthers here. We are going to miss you so much. The most dashing silver fox of the Fin Review and an incredible colleague. Nobody could ask for a better colleague. You're an absolute champion. You will leave a huge void in the newsroom. But we all wish you well. I will miss you so much from our pod. You really light it up. And who is going to leave Bloomberg printouts of what big cruise lines are doing on global markets on my desk with a drawing of a cruise ship, no less? Tony, stay in touch. Have I got lots of cruises for you and the lovely Claire? Bye.
Here's AFR reporter Jess Sire.
Hi, it's Jessica Sire here. I just wanted to wish Tony goodbye and good luck. He's been a remarkable journalist to watch in action, and as such, I've written him a limerick. Tony Boyd was a masterful chook. He never let any execs off the hook. He could follow the cash and end up with the splash and also crow from the back of the book. Enjoy your retirement, Tony. Thanks for everything.
Here's Matthias Cormann, head of the OECD.
Always a very interesting way of reporting on what was happening in the business world. I always found it was always one of my first reads in the Financial Review on the back page. So I miss it for sure. Because, it was always very interesting, very entertaining, but also very informative. So, yes, I'll miss it.
Here's listener Patrick Corbett.
Wishing you all the best in your upcoming retirement. I started reading your articles back in 1999 when I finished uni, and my first job out of uni was with an online stockbroking firm, and enjoyed the bubble, and unfortunately lived through the burst, and enjoyed reading your articles and trying to make sense of it all way back then. Jump forward to 2023. I'm running my family's winery down in the southwest of WA. Still a avid reader of the Fin, subscriber, listener to your podcast, which I've very much enjoyed. Enjoyed reading your stories all these years. Learned lots. Also loved your sense of humour. I do wish you all the best in your retirement, and if you're ever over in WA, make sure to come down to the Great Southern and enjoy some of the drops that we have down our way. All the best.
Here's Richard Spurio from Allens.
I will miss reading Chanticleer. I think it's one of the must-reads in the paper, so we will absolutely miss reading that and missing his insights.
Here's listener Richard White.
Mr. Boyd is leaving. Hi there, the gang responsible for Chanticleer. Both Krista and I have enjoyed the presentations, written insights, and just all round the camaraderie of the program, along with the writings of you all and participation. But this in particular space and time is only fitting to say the fondest farewell to Mr. Boyd, the supremo of knowledge and one of the most insightful commentators of all time here in Oz. to thank him for his warmth and genuine, insightful, honest commentary over the time with AFR. We wish him every best wish and long may he endure. Richard A.R. White, OAM JP, and Christine J. White. Thank you.
Here's AFR Economics Editor, John Keogh.
Hi Tony, wishing you and your family very well in retirement. Thanks for all the guidance and assistance over the years at the Fin Review, and looking forward to hearing how the Chook Super Fund performs in the retirement years. Cheers, John Keogh.
Here's AFR Boss Editor, Sally Patton.
Boydie, it's Super Sally here. I can't tell you how much I will miss you. Thank you so much for your insights, your intellect, your humour. Thank you so much for years and years of thought-provoking columns. We will miss you so much.
Here's AFR Companies Editor, Victoria Teberger.
Hey Tony, it's Victoria Teberger here. What a magnificent contribution you've made across financial journalism, not just here at the Fin, but everywhere that you've worked. And I also wanted just to thank you for the tremendous help that you've been to reporters, right across the newsroom, in terms of sharing your knowledge and the back history of companies and boards, and going back, 4 or 5 or 8 CEOs prior to the current management of firms. So all the best, mate, and enjoy the surfing. Cheers.
Thanks for everything, Tony.
And we look forward to having him back on the Chanticleer podcast soon.
The Australian Financial Review.